Good morning and welcome to the Business Standard Morning Show. I'm Debarghi Sanyal. It's the 16th of August 2023 and here are the questions we'll be answering today. How will China's economic troubles hit India and the world? Does India's policymaking need a rejig? Is it time to turn cautious on stocks of new age companies? And what is protectionism? A host of news emerging from China in the last few days has set the alarm bells ringing around the world. It is being heard in India too. China's economy has slipped into deflation. Its exports have fallen by over 14% in dollar terms and imports by 12%. Add to it the ballooning local government debt and the housing market slump. It's a crisis in making, at least on the face of it. In our first segment, Abhijit Kumar speaks to experts to find out how serious this crisis is and what does it mean for India and the world.
The world's second largest economy is grinding to a halt. China's juggernaut, which also kept the world moving, is slowing down. Its economy has slipped into deflation as the consumer price index, which is the main gauge of inflation, fell by 0.3% year-on-year in July for the first time in more than 2 years. The producer's price index, which tracks prices at the factory gate, dropped by 4.4% in the same period. This is the first time both the indices have been negative since November 2020. China has had a tryst with deflation in the past too. The country experienced a short period of deflation at the end of 2020 due to a steep collapse in pork prices. Prior to that, the economy faced a decline in 2009. Adding to the woes, China's exports contracted 14.5% and its imports dropped 12.4% in July year-on-year. Analysts suggest that the decline in exports, a major driver of China's growth, has been due to lower prices while the volume of goods have reached pre-pandemic levels. China's exports to the European Union have slipped by 39.5% from last year to $42.4 billion, while exports to the US have fallen by 23% to $42.3 billion. So, how will this affect the world economy?
Some analysts in the West are arguing that this could be a good news for the Western economies. The Chinese were the suppliers of intermediates and also finished products. Yeah, if they suffer fall in, they suffer deflation, their products become cheaper. It'll be helpful for the Western economies to overcome the inflationary spiral that they have been experiencing. But that may not be the case because if like I said, that China has been influencing global growth. If the global growth slows down, then it's going to have all-round effect, the benefits that may be very short-lived.
An IMF report earlier this year predicted that India and China will account for half of the world's growth this year. The organization had said Asia Pacific's GDP will expand 4.6% this year. The IMF had pegged the world economic growth at 3% for 2023, but with the recent economic slump in China, those numbers might see a revision. As a major player in the global supply chain, a decrease in Chinese demand will affect economies that depend on exporting goods to China. Falling Chinese imports can lead to reduced growth in countries reliant on these exports, thereby dampening the global economic outlook.
There is going to be a negative impact on the global economy because, in a sense, the global economy has become addicted to a very rapidly growing China. But there are other aspects we have to take into account. You see, China's role in the global economy has been very much determined by its positioning itself in the global value chains and global supply chains. So it has made itself, in a sense, to be a indispensable partner. In the short term, moving away from these global supply chains in which China is the dominant partner, this is unlikely to happen.
For India, the consequences of a slump in China's economy are multifaceted. Data from China's General Administration of Customs, or GAC, suggested India's imports from China fell 0.9% to $56.53 billion in the first half of 2023, as against $57.51 billion in the first half of 2022. However, due to weak demand in China, India's exports to the country also fell by 0.6% to $9.49 billion in the first half of this year.
Negative effect on India will be through the negative effect of a slowing Chinese economy on the global economy. Because as you know, 30% of the global growth rate, GDP growth rate, is accounted for by China. Second aspect is that, of course, this should open up opportunities for India. India has the opportunity to position itself to become a more attractive destination for investment, also as a major trading partner for the rest of the world.
For us, cheaper Chinese products flooding our markets has always been a threat, irrespective of what is the situation in China. There's a greater possibility of these Chinese products coming into the Indian market and affecting our own industries.
China's deflation stands in sharp contrast with the other big economies which are reeling under high inflation. The scars of a stringent lockdown, it seems, are still fresh in people's minds. And to make them loosen the purse strings will need efforts from the government. Some experts see stimulus measures from the government, including tax cuts.
India, meanwhile, is trying hard to emerge as an alternative to China, and its attempts are meeting with some success too. The country is set to cross 1.2 trillion rupees in mobile phone exports in the current fiscal year, thanks to its PLI scheme. But in some areas, its policymakers are still testing the waters. Recent move to include international credit card spends outside India under the liberalized remittance scheme and its withdrawal surprised many. So did the immediate import curbs on laptops and its subsequent extension. So, does India's policy making need a rejig? Ayush Mishra and Tariq Ahmed explore. Budget 2023 raised the tax collected at source or TCS rate for foreign remittances under the Liberalized Remittance Scheme or LRS from 5% to 20% for all transactions except medical and education. The new rate was supposed to kick in from July 2023. The policy change attracted criticism because of the sudden 15% jump and confusions regarding what payment methods are included in the 20% TCS. After multiple notifications which only added to the concerns, the Finance Ministry finally decided to collect the tax collected at source at 5% on transactions above 7 lakh rupees from October 1st. But this was one of the many policy changes that the present government has made and rolled back following criticism from the public and industry. Earlier, the GST Council in its July 11 meeting decided to levy a uniform 28% tax on the full face value for bets and wagers involving online gaming, casinos, and horse racing. While gaming startups alleged that this will lead to unsuitable business conditions, confusions remained about what stages of the game the tax will be collected and how to meet the compliance. However, on August 3, the GST Council softened its stance by deciding a levy of 28% tax only on the initial amount paid on an online game and not on the value of each bet placed. The government also surprised the industry following announcement of IT hardware import restrictions. Citing security risks, Directorate General of Foreign Trade or DGFT banned the laptop import on the 3rd of August with immediate effect. The idea was to curb Chinese imports on security grounds and push local manufacturing. But a day later, the DGFT pushed the implementation to November 1 after customs officials stationed at ports of entry started holding up electronics shipments. Former economics professor of JNU, Arun Kumar, says sudden policy changes can lead to deterioration of the business environment.
What is happening is we are going for ad hoc policy changes. It seems that the wider view within which policy has to be made, that is missing. And that's why we announce some policy, then we withdraw it or change it, and that causes a lot of confusion for the investors, that causes confusion for the manufacturers and the producers, which is not good for the economy because then the business environment deteriorates. And when the business environment deteriorates, then the investment suffers.
So, what should India's policy making be focusing on?
We have to move on the technology front by investing more on R&D. Our R&D expenditure is only 0.7% of the GDP, and our expenditure on education, on public education, is not exceeded 4% of GDP. We should enhance that to at least 6% of GDP. Similarly, the R&D expenditure should be enhanced to at least 2 to 3% in the short run, and maybe in the longer run, somewhat more. Then we'll be able to compete better. We'll be able to have a more stable policy environment vis-a-vis external sector. These policy changes that we are discussing are vis-a-vis the external sector. In the internal economy also, we need to have more long-term policy goals, like, for instance, employment generation for large number of people. Unemployment is very high and inflation is high. If we are able to have a more stable policy environment within the country, that will also help us externally. So employment generation should be the focus for policy making internally. Creating demand in the economy by giving more in the hands of the poorest segments, so that if the demand increases, then production increases, and that will make our industry, produce better and more.
Let us not forget that the objective is not just to have GDP growth, promote business, increase all this. One has to think in terms of the consumer. Now, when you ban a laptop from abroad, you are also hurting the consumer. This is just to take one example, but you can multiply the examples. So there is that effect. And let me add to that, in fact, the larger objective is not GDP growth. The larger objective is welfare. And if we are talking about improvement in welfare, then you definitely need to take into account what is happening to the consumer, the middle class, and of course the poor and the vulnerable.
Experts suggest that for effective policy making, defining national interest is necessary. Framing policy around national interest from a long-time perspective is essential for a favorable business environment. Also, when it comes to technology, the focus should be more on increasing the domestic technology manufacturing capabilities instead of blanket curbs on import. Most government policies have a bearing on financial markets too. The reaction at times is quick, like what we saw in the case of laptop import curbs when related domestic stocks soared on the bourses. Moving on, Q1 FY24 results season is drawing to a close with many new age companies showing first signs of profitability during this quarter. At the bourses, shares of related companies have surged up to 62% thus far in 2023, outperforming the benchmark indices by a wide margin. Given the sharp run-up, should investors book profit in these counters? Or do the financial results put them on a growth runway? Nikita Vashisht explores these questions in our next report.
shares of most new age companies have outperformed the benchmark indices so far this year as market bulls took the center stage. So far in 2023, stock prices of Paytm and PB Fintech have surged over 60% each, while that of Nykaa have tumbled 13%. By comparison, the key Nifty 50 and Nifty 500 indices have advanced up to 9% during the period. Analysts said hopes of improved earnings growth along with the overall market momentum, especially in the mid and small caps during calendar year 2023, contributed to the up move. However, they say it's time to turn cautious.
These stocks have rallied amidst a bull run in the overall market, thereby making them vulnerable to selling pressure at peaks. It is advisable for investors to exercise caution and avoid adding these stocks to the portfolios until the financial outlook of these companies exhibits a robust upturn.
During the recently concluded April-June quarter of the financial year 2023-24, food delivery platform Zomato reported a consolidated net profit for the first time at 2 crore rupees. PB Fintech, the parent company of Policybazaar, meanwhile, reported a positive EBITDA for the first time at 23 crore rupees. Nykaa, the online beauty retailer owned by FSN e-commerce, was the only company that reported a 26% year-on-year decline in the net profit. Analysts, however, say it is too early to say that these companies are out of the woods.
We are also extremely impressed by their amazing growth numbers. But there are various concerns around the future growth potential as well as the valuation that you need to understand before you invest into these stocks. In the long term, the sustainability of the business, how well they can maintain the competitive advantage, their ability to innovate and expand will be key to finding out winners in this segment.
At current levels, the price to earnings multiple for these companies range from 83 times to 252 times for FY25 earnings. Against this backdrop, market watchers suggest short-term investors to book out and buy selectively after significant declines in their prices. On August 16, markets will resume trading after a day's holiday. The UK's inflation print, the US's industrial production data, Q1 earnings back home will be on investors' radar.
Strong performance by new age companies is indeed a good sign, not just for the markets but also for the country's economy, which is being called a bright spot. But the central government believes India Inc. still needs some insulation from global competition. It recently announced a plan to impose curbs on the import of laptops and personal computers. And as the move was being hailed or criticized by experts, it has been reported that the cameras and printers may also join the list of items facing import curbs. Some industry experts have claimed that these steps are leading towards the old era of protectionism. But what is protectionism? Raghav Agarwal explains.
Protectionism is known as the government policies that restrict international trade to help domestic industries. This is usually done to improve economic activity in the domestic economy, but can also be imposed for quality and safety concerns. Some of the policies that are used by the government include tariffs, import quotas, product standards, and subsidies. Typically, protectionist policies are focused on imports. It aims to limit imports so that the domestic industry innovates and meets the gap created in the market through its products. There are 4 types of policies that are used to promote protectionism, namely tariffs, import quotas, product standards, and government subsidies. Under tariffs, an additional levy is to be paid on products which are imported into a country. These increase the price of the product for the customers. Sometimes a country also imposes tariffs in response to the other country's tariffs. These are called retaliatory tariffs. Under import quotas, the government puts in place a cap on the number of products that can be imported over a period of time. This limits the supply and in many cases undertaken to prevent dumping. If a product is completely prohibited, it is known as an embargo. Product standards are imposed in the case of quality concerns. Here, regulatory standards are imposed on the products, and if the imported goods do not meet the standards, they are stopped from entering the country. Under subsidies, the government provides domestic businesses with cash. This also comes in the form of interest-free loans and tax breaks. Both the supporters and the critics of protectionism hold strong views. Critics argue it often hurts the people and entities it is intended to protect by slowing economic growth and increasing price inflation, making free trade a better alternative. The supporters of protectionism argue that the policies can help to create domestic jobs, increase gross domestic product, and make a domestic economy more competitive globally.
I will achieve, I will fly high. I am the SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Several experts, meanwhile, have claimed that the world is increasingly moving towards protectionism. India recently claimed that the US and European plan to subsidize domestic renewable energy industries are tantamount to Western protectionism. Well, that's all for today. For more news and analysis, please log in to business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.